Welcome in. Glad to have you on the Smart Mortgage Show. Got a good show coming up for you today. We're going to talk about a few different things. We're going to first get into another market update, get the latest from Bill on what's happening in the market. But beyond that, we're going to get into some historical data and look at that, why it's actually still a really good time to be buying. We'll get into that. Plus, we'll answer a question today about credit score. If you have a credit score that's maybe not up to where you want that to be, is it still okay to buy? What are maybe some restrictions you might have? What are some things you can do to maybe change your situation? And also we're going to focus today as well on different financing options that are maybe starting to kind of trend during this current market environment. We'll discuss all that coming up today. Stay with us. Well, glad to have you on the show. Bill, welcome in. I know you're staying busy as always, but how's everything?
Good, Ben. Good. Yeah, nice to see you. And we're staying busy. I would say we're staying steady, actually. The market is going through a cycle. You know, in the mortgage world, you know, COVID for us was super busy. And, you know, the way things work, if you have a big boom, you're going to have sometimes a bust after, and the mortgage industry is in that territory. But we've been lucky. We've got a lot of great partnerships in the community, helping people to still buy houses. So we're positioned well and grateful to be in this position.
Well, I know that the home buying never stops, right? Buying and selling never ends. So we got some things on our mind. I know that you probably have some things on your mind as well that we're going to get into on today's show. But I'll remind you, if you haven't joined us before, we're glad that you're here. Bill is a regional president of Cross Country Mortgage. You can find everything we do online at smartmortgageshow.com. But you can also call him at 484-352-4151. Take advantage of his free 15-minute loan consultation. If you're in the market for a new home, good time to sit down, just kind of begin those conversations on what to expect from the mortgage process, what they can offer you, and just begin talking through some of that as well. But we got some good things we want to answer today.
It's time for the market update.
Getting into the market to kind of kick things off, Bill, you know, you're kind of talking about where we are, but I think kind of peeling back a little bit, because I don't think we've changed a whole lot, right, since October into November in terms of rates and that sort of thing, correct?
Yeah, so rates have gone up a bit, and right now we're sitting for a 30-year fixed just below 8%, so 7.99 would be a 30-year fixed rate mortgage on average. So rates are continuing to stay high, maybe longer than what a lot of economists thought.
Yeah, no, we talked about that a little bit on the last episode, so go check that out. But I know you wanted to kind of get into a little bit of the historical angle on this as well, because, you know, people still hear 7 and 8 and kind of freak out like, oh man, we were just at 2 or 3, right? I could have gotten a great deal. The rates are still super high. You know, I got to wait. But when you kind of pull back and you look over the history of the real estate market, 7-8% is actually still pretty favorable, correct?
7 or 8% historically is a really good rate. Now, some of the millennials who only knew 2, 3, and 4%, they've never known anything different, right? But the older that you are, you've seen quite a few markets. So absolutely the rates are not terrible. Higher than we would like, but certainly, you know, buying a house is still a good investment. And here's one of the things that, you know, I want to clear up, because the purpose of this show is to disseminate good information. And there's a lot of, you know, bad information out there. We get fed a lot from a lot of different sources. So I always like to look at the data. Whenever we put a loan estimate in front of a customer for a refinance, I always say that the numbers on the page are going to speak way louder than I do. Let's look at it in writing. So when we look at house values locally, where I am, right? So Chester County, Pennsylvania, Delaware County, Pennsylvania, Newcastle County, Delaware. So like southeastern Pennsylvania, south of Philadelphia, our values have increased considerably through COVID, and combination of a lack of inventory and very low interest rates. Now, we're out of COVID. Most of the economy has resumed back to normal. We still feel some inflationary pressure. Rates are close to 8%, but our housing market continues to be strong. And that is one of the things I want to press home here today is, are we going to see a a bubble? Is there a bubble? Is it going to bust? Are house values going to plunge suddenly? And we don't think that's going to happen. And we wanted to talk to you about why we don't think it's going to happen.
Yeah, I'd love to hear some of this information as well. And, if we can, we'll probably share some graphics, some visuals with you as well, because I think it's important to kind of paint the picture and explain that, because I know that is a big concern. I mean, are you hearing that quite frequently from people, Bill? Like, hey, are we in a bubble? Should I wait? Because I've heard, or my friends told me that, the market's going to collapse at some point, and I don't want to be at the top end of this thing.
Yeah, and by the way, I mean, you just made a good point. A lot of times it might be a friend that says something and they mean well. Yeah. And they're getting information from maybe not the most credible source. So in what we do, we need to make sure that we're disseminating really good information. And we can't say that buying a house is right for everyone. There are reasons why you would not want to buy a house. If you were going to, only be in the house for a very short period of time, it might not make sense to pay closing costs buying and selling in a short period of time. And there's some other reasons as well. But for most people, we're hearing a lot of people say, I want to wait because we're trying to wait out the market. And trying to time this market could be a really big mistake. So there's a lot of talk of recession. So one of the interesting key metrics that we've been looking at is that in 8 of the last 9 recessions, house values have increased through the recession period. The most recent recession being COVID, which is kind of like a synthetic man-made recession because we just closed everything, right?
Right.
But the one that I think that people point to most is 2008. And it was very recent and it was very dramatic. So it's left this, scar. But technically 2008 was different. So of those 9 recessions, that's the one was different where values went down. But the values went down because the recession was caused by the housing and the lending crisis, right? It's not like the housing and lending crisis was caused by the economy. Mm-hmm. Okay. So at the core of it was housing, and that's when we saw housing decrease. So highly unlikely that if we go into a recession, we're going to see another decrease in house values.
I saw something online, a stat that said like 64% of Americans would welcome a recession if it meant lower mortgage rates. So it's interesting. I think we just assume, hey, a recession means it's going to be a negative in terms of like house values and stuff. But you're saying the opposite, that typically doesn't necessarily correlate.
Doesn't necessarily correlate with house values. But if you think about it, Ben, really good point. A recession's probably going to mean lower mortgage rates. And when that happens, you're going to have more buyers. So now you're going to have more demand on a market that inventory is already very low in, right? So when, again, pointing back to 2008, inventory levels were, there were 4 million homes on the market in 2007. Right now, there's about 1 million homes on the market. So there's a lot of demand and not a lot of supply right now. So further reason why we think house values will continue to climb. And if you look historically, in roughly the last 80 years, in 73 years, house values have increased. Only 7 years have they decreased, and 1 year did they stay even. Okay. Now, 5 of those years were through the Great Recession. Only 2 other, in 80 years, 2 other times did house values decrease, and they didn't decrease by much. But very interesting is if you look in 1943 through 1947, over the United States, on average, house values compounded 118% increase. So that's more than the increase that we've seen through COVID. But people are thinking, we saw a big increase, there's going to be a crash. If you had tried to wait out that market, you would have waited 43 years
Jeez.
For a value to start decreasing. So I hear a lot of people say, I'm going to wait until the values come down. If history is any predictor of future, and lots of time it is, you're going to wait a long time. So we feel like there's a lot of data that suggests that values are going to continue to increase. We live in a great country, and the housing market is housing is the largest sector, the largest industry in our country. It's very well supported, and we feel like it's going to continue to increase. Now, it's not going to increase the way that it did through COVID. Those numbers aren't necessarily sustainable, but the values will continue to increase over time. And if you're waiting, you might be waiting a long time.
Yeah, it seems like it's kind of like time in the stock market, right? You have to be right a couple times, right? You're trying to find the perfect rate plus the perfect house, and you're trying to catch it at the right spot in the market in terms of value. It's almost impossible to do. And to your point, I mean, if no matter where you bought, I mean, you've pretty much been in a better position years down the road, right? And most people aren't buying a house to necessarily turn it over in a year or two and making it's some kind of income off of that, right? It's more of an investment for the future, and it might not be the absolute best time to buy where it was maybe a couple of years ago potentially, but it's still a really good time to buy, and you'll often be better off having made that investment rather than waiting around. So it's kind of like anything else, Bill. There's not perfect timing, right? You just kind of have to find your spot, and if it makes sense and you're ready to move forward with a house, this is probably as good a time as any.
It's not timing the market, it's time in the market, right? Mm-hmm. And Warren Buffett's famous for saying he can't time the market. So I don't know how I would expect to be able to do it if he can't.
Right.
But yeah, you're right. It's about, not looking for the perfect rate and the perfect house that's going to increase at the perfect time. What it is getting in the market, and over time, you will experience gains.
Very good reminder. And I know that, the rates continue to kind of stay where they are, ticked up a little bit in November. I mean, do you anticipate anything over the next couple of months, Bill, that could shift things one way or the other? Is there anything on the horizon that you're keeping an eye on as we close out this year and then move into 2024?
Yeah. So what we're seeing that when the Fed came out and said we're going to keep rates higher for longer, the market made an adjustment. We feel like the market has adjusted to that language, which is right around an 8% interest rate. Now, if the Fed comes out next month and they make some comments that would not be good for the bond market, then rates could go up. But on the flip side, what we're seeing is looking at key inflation figures, and if you look at CPI, Consumer Price Index, measure of inflation, but you break down the core components, inflation is coming down, not in every area, because when I say this to people, they say, well, why isn't, a loaf of bread coming down at the store? And, every time I go grocery shopping, the bill is higher. And, that may not reset, right? Because if inflation cools, it means it just might stay at that level, and future increases will not be as, egregious as they've been in the past few years. Mm-hmm. So looking at those inflation numbers, though, they are coming down, and as they come down, interest rates will come down. So we feel like probably rates are going to remain high through the end of the year. Some rate relief will hit 30-year fixed rate mortgages in the broader mortgage market in 2024.
All right, very good. Well, good look at things, some good perspective to kind of keep in mind. I know when we're in the middle of this, it can be kind of frustrating if you're looking to buy a home and you're hoping the rates will drop, and they haven't over the last few months. So it's a good reminder that, it's still probably a good time to buy, and history has shown us that. But if you want to, begin that conversation, you want to sit down with someone, going to encourage you to reach out to Bill over Cross Country Mortgage. Find him online, smartmortgageshow.com. Not only do we have our podcast, we have videos up there as well. You can find all that information there, but you can also call 484-352-4151. Bill's office is located there in Chadds Ford, Pennsylvania. But again, everything is online at smartmortgageshow.com. All right, let's shift gears now and go to a different conversation here, Bill, with the way things are in the market. And it seems like, we are seeing some different trends, some different ways in which people approach financing, right? So some different kind of trends have popped up during this, I guess, period that maybe weren't around 2 or 3 years ago, correct?
Yeah, so typically when rates are really, really low and things are affordable and underwriting is all in line because of the low rates, you're usually just dealing with most of your basic Fannie Mae, Freddie Mac, FHA type products. And when rates go up and the ratios don't work and we need to look outside the box, or we want to consolidate debt and try to not touch the 3% low rate first mortgage, now we look at different options to still help with people's needs. And there's some products out there that are really well suited to do so.
So we're going to talk you through those here right now on the show. Again, if you have questions for Bill, 484-352-4151. And again, take advantage of the free mortgage and loan consultation. It's very simple. You can get on Bill's calendar and begin talking about these things and look at some of these options, right? I mean, part of that is the discovery process in terms of what products are out there for you that potentially can fit your situation, but before they can provide you any kind of guidance, they need to, of course, learn the details and what your goals are and kind of what position you're in. So something to remember. But what's the one loan, Bill, you were kind of talking to me about it before we got on that I'd never heard of, the DSCR loan?
Yeah, so DSCR is a really good product for anybody who's looking to buy an investment property and they've got some money to invest. You're going to need 20% down, and which is pretty standard for any investment property loan, but maybe you don't have the income to help qualify. And you want to be an investor and you're really interested in building a portfolio. This product, DSCR stands for Debt Service Coverage Ratio. And what that means is they're not looking at your W-2 or your self-employed income at all. They're looking at funds to close, got to have decent credit score. Most important though, they're looking at how does the house that you're looking at, how does it debt service onto itself? Meaning a 1-to-1 debt service ratio, which is favorable with these loans, means if the mortgage payment's $1,000 and the rent is $1,000 that you could expect per month, that's a 1-to-1 ratio. So that the bank is comfortable with that because they can see that the rents can pay the mortgage, so they like that. You get a better rate if it's 1.25%. So the rates vary based on that coverage ratio. So if the mortgage payment's $1,000 and the rents are $1,250, you're actually going to get a better rate because that's a less risky proposition for the lender. And you could also go the other way. So if the rents are $750 a month and the payment is $1,000, that's a 0.75 DSCR ratio. That loan is you're still able to do that loan. They're going to want more money down and they're going to charge you a higher rate. There is actually a product that's a no ratio where they don't look at that DSCR coverage ratio at all. They do require more money down. The loan has to be better collateralized in order to do it. But main point here, Ben, is there's a lot of really good options for investors right now, and these have been more popularized because of where rates are.
Yeah, this is, again, kind of focusing on some things that have maybe risen in popularity that maybe weren't as popular a few years back because the market conditions really didn't call for that need. Another kind of situation that people are often in right now too, Bill, is your first mortgage, you got a great rate, right? A great mortgage rate. You don't really want to touch things because you want to keep that number locked in. But the other problem people are facing, right, is high consumer debt. That seems to be a pretty common trend across the country right now as Americans are taking on pretty high levels of consumer debt. So there are some options out there, right, that can kind of help you consolidate the debt.
Yeah, so again, as you've mentioned, in a low rate environment, you'd put it all under one roof in your main first mortgage. But in this market, a lot of times, and we do a lot of help with debt consolidation because, we're looking at overall financial picture. It's a holistic view. A lot of times we're working with our clients' CPAs and financial advisors to figure out the best plan. And sometimes right now, or I'd say more often than not right now, the first mortgage rate's at 3%. We want to consolidate some debt. but we don't want to disturb that 3% rate. So we might look at a 8 or 9% second mortgage. But what happens is if you're consolidating 15 to 20% interest rate credit cards, or you're pulling a car loan in there and you're stretching it out, you're creating cash flow. And a lot of times what we see is if you take that cash flow and roll it back into the loan, you can pay the loan off very quickly. So pivoting from that first mortgage where you would roll it all into one, now we're looking at a first mortgage that you already have, leave that alone, add the second mortgage, home equity line of credit, or a home equity loan, depending on your situation. And that's the kind of thing we'd need to talk through and better understand. But now your blended interest rate of all your debt is a lot lower than the blended rate with all this high interest rate credit card debt.
Makes sense. And is that an option that's mainly tailored to people that are already working with cross country, or can somebody come in with a loan elsewhere, let's say, and come in and talk to you about this option?
Yeah, so we can help anybody from any walk of life, and it does not need to be somebody who's just closed a loan with cross country in the past.
Okay, good to know. Well, if you are curious about any of these options, again, go to smartmortgageshow.com. You can call Bill at Cross Country at 484-352-4151. Anything else, Bill, you wanted to add to this? I know these are two options that are out there now that are maybe more common now than they were in past years, but is there anything else on your radar?
Yeah, so just that in general, when you're working with a mortgage company, you want to work with a company that's asking a lot of questions to understand exactly what your scenario is. Sometimes our answer is don't do anything because there just isn't a good solution. Trying to just fit somebody into a solution just for the sake of closing a loan is a really bad practice. So just make sure, with us, if you call in and we discuss your scenario, we're going to look at it from all angles, make sure that we're helping you make the very best decision possible, because it's a big debt encumbrance on your biggest asset. So there's a lot of care and detail that should go into those decisions.
I think that's important to remind people because, when you throw out, hey, you can get a free 15-minute mortgage and loan consultation with Cross Country and Bill Litton's team, the idea might be, well, they're just going to try to sell me on a product. But the truth is, that's not the case, right? It might even be a result of them saying, hey, maybe this isn't the best fit for you right now, or maybe you should explore some other options that are out there that you hadn't thought of yet.
So there's a good part of what we do is to build a plan if we can't help you, or prepare for a better time when it might make sense to implement one of these strategies, or send you to another lender that is better qualified or has a product that we don't have, because we don't have every product. We're blessed with Cross Country. We've got a lot of product, and we can solve a lot of problems, but we don't have everything. So there are times that I would send somebody to somebody down the street that could better serve the customer, and that's always the goal.
That is always the goal. So if you want to take advantage of that free 15-minute mortgage and loan consultation and learn about these options and whatever else could potentially fit your needs and wherever you're trying to get, whatever home you're trying to get into, whatever your goals are, again, 484-352-4151.
It's time for the Mortgage Mailbag.
All right, time now to open up the mailbag, get to a question, Bill, that came in that I think is a good one, and one that I'm sure a lot of people have asked you in the past, and I know we've addressed probably on this show at some point, but it's always good to kind of go back through these scenarios for people with credit score that maybe they aren't happy with. So today's question is, can someone with a bad credit score, say under 700, still purchase a home if they have the funds for a big down payment?
So first thing I want to mention is just know that 700 is not a bad credit score. Okay. Now, 700 is not what it used to be, because if you had a 740 score, you got the best rate. And then in 20-point increments, the rate went up from there, and 720 used to be the third tier. Now you need a 780. So as Fannie Mae and Freddie Mac have gotten a little bit more strict with interest rate, you're going to get a higher rate now with that 700 score. Okay. But a 700 credit score is actually a pretty good score, and you can obtain most types of loans with a 700 score. There are some situations where you're probably, if your debt ratio is super high and you're trying to do a 3% down loan, you might be prohibited from doing so. But 700 is a pretty good score. You're going to be, have available to you most options.
And two, I know we've talked about this before. If someone came in, let's say that this person came in and, this was kind of one of the first parts of the discussion you had with them about their credit score and that sort of thing, and you talked about different options they might have. You also will probably work with them on, here's some things you can probably do to bump up your credit score, right? Because there are typically some ways to improve your credit score fairly quickly.
Yeah, so we love providing guidance on how to get your scores to increase. In fact, we just put a client under contract who we help bump scores up into an acceptable lending range. This person we had been working with for a little while, and finally we got their scores up, and they just went under contract on Monday. So we're definitely looking. Yeah, it's very exciting for us when that kind of work, culminates into somebody being able to buy a house, and we're always happy to give that advice. And sometimes the advice, Ben, is hey, I had a gentleman that we settled maybe 8-9 months ago. His credit score was a 615, and we said, hey, pay off these 2 credit cards or pay them down. Don't close them. Don't ever close them. Pay them down, and your score is going to go over 740. So with this person, we got a much better interest rate by making 2 changes, and the credit cards he paid down, the balances weren't that high. And that's an extreme example. I wish they were all that pretty, but there's a lot of opportunity there with trying to, make adjustments on the credit report, bump up the scores, get better rates, get qualified at all if you're not qualified. So that's the kind of stuff we're looking to do to help our customers maximize their buying ability.
Yeah, and while that might be an extreme example, I mean, it just goes to show you that you just don't know what you could change until you get in there and have that conversation with someone that can help you, right? Because it could be that you're in a situation too where you could bump up your credit score by 100 points by a couple quick, simpler moves. It might not be the case, but you just don't know until you have that discussion. So to kind of close it out, Bill, is there any credit score that you would say is kind of like the cutoff to, hey, let's do a little bit of work on this before you look into a mortgage? Because I know you say 700 is on the higher end, so maybe it's nothing for this person to worry about. But if somebody came in and said, hey, Bill, my credit score, and I don't know how low they get and how low you actually see, because thankfully I'm fortunate enough to not have been in that low of a category quite yet. But let's say somebody says, I'm under 500, Bill. Can I still get into a home?
Yeah, so what we always say is you're better off having us look at it no matter what it is, because we can tell you how to get to an acceptable score more quickly. We have tools and simulators that we use. Case in point is, I've had this happen many times where I have a client that maybe they're at 550 and they go and they pay off all their collections. And you would think that that's responsible and paying off my collections, that's going to increase my score. Actually, it can decrease your score to pay off collection accounts. You may not need to pay any collections off. You might be completely wasting thousands of dollars by assuming that that's going to help your credit. So we always say, no matter what the score is, let us look at it. This is all we do all day long. We'll help you get to where you need to be more quickly.
Very good. The best place to start, log on, smartmortgageshow.com. You'll find all of our episodes there as well, extra videos that you can sort through. And you can also get in touch with Bill and his team at Cross Country Mortgage, his office there in Chaddsford, Pennsylvania. And again, you can begin the process. Any of these things we talked about today, the best thing to do is to start by having that conversation, going with him and meet and beginning talking about the options, where you're at, what your goals are, and you can start moving forward from that point and see if it is a good fit for you. And if not, I'm sure Bill and his team will have some advice and have a plan for you to get to where you want to go. That's the ultimate goal for Cross Country and for the Litton team. So some good things to think about there. But if you want to call, 484-352-4151 is that number. But again, Bill, great conversation today. I know you kind of got to go with where the market is. I know the financing options are out there right now, right? And looking into those, but also looking at the historical data and talking to people about kind of where we've been in the past and what that could mean for the future. So all very relevant conversation. And hopefully in the future months, we'll be talking about rates coming back down and kind of what that means for the market as well. But in the meantime, encourage everyone to kind of reach out to you. But as always, we appreciate your insight and taking us through our current real estate market.
Yeah, absolutely. Thanks everybody for tuning in, and certainly we're always here to help, so please reach out. We'd love to hear from you.
Very good. For Bill Linton, who is the regional president of Cross Country Mortgage, I am Ben George. Thanks for listening to the Smart Mortgage Show. We'll have a new episode coming soon, so subscribe and stay tuned. This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.